Welcome to the Limitless Retirement Podcast. My name is Danny Gudorf, the owner of Gudorf Financial Group. Whether retirement is on your horizon or you've already made the leap, this podcast tackles your most important questions in retirement.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, a broker-dealer, member FINRA/SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Gudorf Financial Group are not affiliated.
So let's go ahead and get started with today's show. Are you making a dangerous mistake with your retirement money right now? If you're keeping large amounts of cash in those 4 to 5% money market accounts, thinking you're playing it safe, you might actually be putting your entire retirement plan at risk. I'm Danny Gudorf, a financial planner who's helped hundreds of people over 50 retire with confidence. And today, I'm going to show you why that safe cash strategy could cost you thousands of dollars and how to protect your buying power for the next 30 years. You've probably heard that cash is king. This popular phrase came from the CEO of Volvo after the 1987 market crash when he talked about having plenty of cash during tough times. Just like Volvo back then, many retirees rely on cash to protect themselves from financial storms. But here's what's happening today. Many people are treating cash like an investment instead of a safety net because of those attractive 4 to 5% returns we're seeing right now. The problem is there's a silent thief working against you every single day, and it's called inflation. Let me explain what's really happening to your money. When we talk about investment returns, there are two numbers you need to understand. The first is your nominal return. That's the headline number you see before considering inflation, taxes, or fees. So if you put $100,000 in the stock market last year and it's now worth $110,000, your nominal return is 10%. That's the number that gets all the attention, but it doesn't tell the whole story. The real return is what matters for your retirement. This is your return after inflation eats away at your buying power. Using that same example, if your investment returned 10%, but inflation was 6%, your real return was only 4%. That 6% inflation reduced not just your nominal return, but more importantly, your ability to buy the same goods and services. This is why nominal returns will almost always be higher than real returns, except when we have deflation, which is rare. Here's the shocking truth about today's high cash yields. From January 2022 to April 2025, Vanguard's Treasury Money Market Fund returned about 14%, averaging nearly 4% per year. Sounds great, right? But inflation during that same period completely wiped out every bit of that return, and then some, leaving money market investors with a negative 1.42% real return. And that's before taxes. So while people felt like they were finally getting paid to keep money in cash, they were actually losing buying power and missing out on better stock market returns. This isn't much different from the frustrating period from 2009 to 2020 when money market returns averaged only 0.4% and inflation was around 1.6%. Cash yields were terrible, but so was inflation, still leaving investors with negative real returns. The pattern is clear. Over long periods, cash barely keeps up with inflation, if at all. Let me share some historical perspective. For the last 97 years, 1-month Treasury bills returned about 3% per year on average. Want to guess what inflation averaged during that same period? roughly 3%. This means over the long term, cash doesn't increase your buying power at all. It just maintains it, and sometimes not even that. This is exactly why smart retirement investors put a healthy portion of their money in riskier investments like stocks and bonds. They need positive, real returns to protect their buying power and reach their retirement goals. Yes, there was a unique period from 1978 to 1999 when cash outpaced inflation by about 3% per year. But even then, stocks outpaced inflation by about 12% per year. Cash was positive, but it was still a fraction of what the equity market delivered. Here's what this means for your retirement. If you're in the accumulation phase and putting a large percentage of your savings in cash, you're almost guaranteeing lower returns. Remember that period from 1978 to 1999 when cash had some of its best real returns in history? Sure, you would have beaten inflation by 3% per year, but the stock market turned $100,000 into $3.3 million during that same time. That's a wealth building opportunity most long-term savers can't afford to miss. For those already in retirement, viewing current money market and CD yields as smart, low-risk investments increases the chances that inflation will eat away at your buying power. In a worst-case scenario, inflation can consume your entire retirement savings. Most retirees need a positive real return, a return above the inflation rate, to maintain their spending over a 30-plus year retirement. To achieve that, you need to allocate some portion of your portfolio to riskier, higher returning investments. Now, I often hear people say they're using cash as a bond replacement because they don't think bonds are good investments right now. The challenge with this approach is that cash doesn't provide the returns you might need when catastrophic events occur. Let me give you an example. During the great financial crisis from October 2007 to March 2009, the stock market dropped over 50%. Money markets had a total return of about 3% during that period and provided stability. But intermediate treasury bonds returned over 16%. That 16% return during one of the worst recessions in history was incredibly helpful for retirees taking regular withdrawals from their portfolios. They could withdraw money from their bond gains while their stocks went through 18 months of volatility. This shouldn't be surprising. Intermediate treasury bonds contain more risk than money market funds, so they should provide higher returns. This isn't an either-or decision. Retirement investors should have a mix of cash, short-term bonds, and intermediate-term bonds to create what we call a war chest. A simple rule of thumb is to establish a war chest equal to 2 to 5 years of living expenses. It might be 2 years if you want to take more risk, and closer to 5 years if you're very risk averse or have already saved plenty for retirement. Cash is king, and for those in or near retirement, a healthy cash balance is absolutely needed to weather unpredictable storms. But cash is not a long-term investment. Those higher yields might seem attractive until we factor in fees, taxes, and most importantly, inflation. Higher cash yields should not trick long-term retirement investors into thinking they can outsmart the markets and achieve higher returns with less risk. Risk and return go hand in hand. If you want a successful retirement plan that maximizes your retirement income while reducing the chances of running out of money during a 30-plus year retirement, you have to make 30-year investing decisions. Chasing short-term trends even with something as boring as cash, will only increase the long-term risk of your plan. The key is understanding that cash serves a specific purpose in your retirement strategy. It's your safety net, your emergency fund, your buffer against market volatility. But it's not your wealth building tool. For that, you need investments that can outpace inflation over time, even if they come with more short-term volatility. So, what should you do? First, make sure you have an appropriate amount of cash for your situation, typically 2 to 5 years of expenses, as I mentioned. Second, don't let attractive short-term yields fool you into thinking cash is a long-term investment strategy. Third, work with a qualified financial planner who can help you create a balanced approach that gives you both the security you need and the growth potential to maintain your buying power throughout retirement. Remember, the goal isn't to avoid all risk, it's to take appropriate risk for appropriate reward. Your retirement depends on making decisions that will serve you well over decades, not just the next few months or years. Now that you understand why cash alone won't protect your retirement buying power, you need to know how to build a portfolio that can actually grow your wealth over time. In my next video, I'll show you exactly how to structure a 3-bucket retirement portfolio that balances safety with growth potential. Click right here. Thank you for listening to another episode of the Limitless Retirement Podcast. If you want to see how Gudorf Financial Group can help you get the most out of your money, go to gudorffinancial.com/get started. This is where you can schedule a 20-minute call to see how our firm can help prepare a free retirement assessment. Please remember, nothing we discuss on this podcast is intended to serve as advice. You should always consult a financial, legal, or tax professional that is familiar with your unique circumstances before making any financial decisions.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, a broker-dealer, member FINRA/SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Gudorf Financial Group are not affiliated.